Good morning, folks. It's 8 a.m. Chicago time on Thursday, the 27th of July, 2023. This is episode number 2511. Thanks for joining me this morning. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, as we look at the convergent trading pre-market summary sheet here, we know that the Fed was yesterday. Some of the recessionary fears that were lingering were taken off the table in the commentary. And then today we got the ECB. The European Central Bank. Lagarde reiterates that inflation remains too high. This says economic outlook is deteriorating. We did get a slew of numbers this morning. GDP, which it's not really descriptive of what's going on in the economy as much as we think it is. GDP advanced Q2 came in at 2.4% versus 1.8 expected. The core PCE prices advance number was better at 3.8% versus 4%. Initial claims at 221,000 versus 235,000 expected. This is the lowest since February. We also got durable goods ex transports, and so on and so on and so on, including wholesale inventories and a bunch of others. So pretty busy this morning in terms of releases. The overall risk posture is strong risk on this morning, with the NQ over 100 basis points, currently 111 basis points over the Dow, which is really, really odd. We see that the Nasdaq's up 206 points, the Dow's up 75 points, the S&P up 33 points, and the Russell, which is in line with the S&P currently, is up 13 points. The Euro Stoxx 50 popping higher at 1.88%, and the DAX up 1.31. Clearly, allocation is to equities, to risk this morning, and that's the theme overall. Shell, Total Energies, Mercedes-Benz, Valero, Comcast, and a bunch of others, AbbVie, Bristol-Myers Squibb, reported this morning. I'm not going to go through those individual reports. After the close, we're looking for Ford, T-Mobile, and World Kinetic, as well as Intel, Mondelez, which is another huge brand, all report after the close today. Earnings remain in focus. And then the ECB rate decision announced in press conference is ongoing. Q&A still taking place with with ECB's President Lagarde. She says the decision by the ECB today was unanimous. The expectation was to raise 25 basis points, and they did. And they held the deposit facility also. The deposit facility rate also raised that at 25%, 25 basis points today. And again, she's saying that that decision was unanimous. So that's where that stands. What's left for today? We have what's left for today? We have pending home sales. Pending home sales month on month expected to drop 0.5% in June over May. May's number came in at negative 2.7% year on year. An expected drop of 19%. The prior's negative 22%. Housing market softening there. And then we get natural gas today, and then that's pretty much it. The Bank of Japan rate decision this evening is also important. So overall, the market's been in a trending condition. The S&P 500's traded 229,000 contracts. 92% of that is long. The inventory is 92% long. 92% of 229,000 contracts traded above yesterday's close. And then the range is 43 points. 43 points, which is quite wide compared to the prior days. I mean, it's ginormous. The last few days have been around 11, 12, 16. We had 22, something like that. What was it yesterday? Yesterday it was 21, 22. So 43 is well above 1 sigma over the last 252 days. You could see it right here. Let me bring a better highlighter in. You could see it right here, the stat that we're looking at right there. What is the edge of normal, or 1 sigma, over the last 252 sessions for the overnight range? That number's 42, and we are at 43 and a quarter, and that's why it's colored blue here. It's telling us that this is unusual. The mode is 28. The mode, the most common value over 252 days in the overnight session by the time the US market opens, is 28 points. Today we're at 43 and a quarter. So take that into account, the fact that the range is quite wide as we come into the session. Let's take a look at what we've got here. So the ES yesterday, if you recall, the key area that I talked about, if you watched yesterday's video or you were present, was 91.92. Those of you who are here should remember this level. This was a key level in this region. It represents a low volume node in between two distributions from the prior session. It represents a prior high, multiple highs. And yesterday, the idea is, as long as it remains below it, we're looking for a test down into the 70, the 80 area, the 45-80 area. And if it breaks above, then we're looking for 600 first, and we're looking for the weak double top that we had over the last few sessions. So if you recall, the S&P put in a high, pulled back several days later, put in a slightly lower high, and if it takes out the 91, 92, we're likely to run the 600 very quickly, and then the double top becomes the key target. And that's what it accomplished yesterday as a result of the FOMC, or right after the FOMC, which came out right in here, the FOMC right in there, and then it just ran up, took care of that. We could see that there was a fight as soon as it took out that 46.0875. The highs were 46.09 quarter, 46.09 quarter, and then the high that was put in 2 days ago was 46.0875. So it missed the top by 2 ticks, and you could see that as it came into this top, you could see these collisions coming in. I had warned about this in the Convergent Mavens channel to say, hey, I'm seeing this thing kind of having to grind through limit offers that are trading out. In other words, a lot of collisions. It rolls over. The next comment that was made is, if it doesn't hold the 91, 92 area, it is likely to sell off into the close, which it ended up selling off a little bit down into the 75, but it turned the other way. I didn't expect this. I actually expected it back at 45, 65. If you recall this number, that's where I was looking for the market to kind of fall through after the FOMC, squeezing the weak and late longs. It just did not do that, making the closing trade, in my opinion, quite challenging. It was difficult to see what it was trying to accomplish once it took out the 92 from above. There was an opportunity right in there. I know it's very, very small to see. Some of this stuff is some of the entry points that I use are very, seem very minuscule on a chart, but they actually are prices that traded. You could see a little pullback right in there, right after poking through the VWAP, giving us an opportunity to get short, giving us an impulse move and then a continuation to follow. But I did anticipate that this would continue lower. Ended up coming all the way back and scratching out the runner, which kind of stinks. But if you look at what happened next, that was, that wasn't too bad. So we ended up settling yesterday at 45.95, right underneath the 4600, and then from there we are just, we got liftoff. It's just a runner. You could see that the profile today is a multi-distribution profile. There's Grok right there smoking his little doobie or cigarette or whatever, depending on the state you're from. You had the multi-distribution profile today. You could see that the market moved from this distribution into this distribution caused by this kind of ascending zipper, ascending triangle, to this distribution where it traded enough volume to bring the point of control and hold it steady here, to now a wide distribution after the numbers. The numbers came out right here. Market lifted on the numbers, took out the high, pushed through the 4630, and has been sitting ever since. So we have pretty good separation between the overnight levels and price. So we have the point of control, we have distance to the point of control, distance to the VWAP, giving us 16 as a key area to watch currently, 16. And then we have quite a bit of distance from price to the mid. This, to me, looks like it has a pretty decent potential to be exhausted. So this morning, the primary push is expected to be an open that is in a gap. Remember, versus yesterday's action. Yesterday's high was what? 46.10, 46.10.75 is yesterday's high. As a result, 46.10.75 right in here. Okay. As a result, we have a gap zone. We're opening at 46.30, which gives us a gap mid currently at 46.20. Gives us a little bit of potential support at 16.17. The idea here is to open, squeeze that high, and get the last push out of the way, squeeze that high, and then flush back in, and then most likely tag the overnight point of control stat back into the 20 here, and then hold this 16 area, retest the 16 area, giving us a 35-ish, 35, 37 to about 16 kind of range to play with. Do we expect that we would fill in the gap zone, given that it's about 20 points deep? It can do that. The probabilities are not in favor of a gap that deep to be filled, but we're at new highs of year. Here's the thing: gap rules apply today. You do not want to fade this gap. This is one of those situations where you have to see the market failing to get short. What we don't want to see is a market that's trading in a gap, squeezing higher, consolidating, and then you're trying to sell it when it might just pull back and continue to squeeze. Generally, gaps, if they don't pull back aggressively, meaning an impulse right off the open, they generally hold or squeeze higher in the direction of the gap. So in that situation, we call this a gap and go, kind of environment. So You have the gap. The market is not interested in selling at that point. The sellers are running for the hills, or the sellers are anticipating higher prices, or will want to unload at higher prices. So what we don't want to do is come in here and execute this plan here just because we anticipate it. We are fading the gap. So I want to caution you, although this is what I'm expecting as a primary idea, I'm cautioning you not to get short right off the open, or to stock shorts, or to go fishing for shorts, or to go find shorts. Let them come to you. And the way they come to us is they push through the open. They have a weak pullback. We want to see an impulse down, a weak pullback, and then a continuation. And then we are free, we're potentially free and clear to 20 and 16, 17. The normal behavior of a gap is responsive selling to balance the overnight inventory, which, as I told you, is at what, 92%. And then we get an impulse higher, and then we either consolidate or we continue to squeeze, and we leave this gap behind for another day, and this becomes a gap zone. That's the normal behavior we're looking for. And up top, we're looking for 46.50 as the next test area. That is a key, this mid-century key strike figure. Here's the bigger picture. So that's the minutia, right? That's the small stuff. Here's the bigger picture. There's your high. There's your double top. There's the break, the poke through the double top. And this is where we are. So there's quite a bit of distance here for us to cover, with the mid being around the 20 area. So to me, even if I were short, the 20 is going to be a key target zone, because the mid, if you back check, you'll find that mids play a pretty big role. But overall, we're leaving this auction behind. We're even leaving this auction behind, and we are clearly indicating that we are strong. So in other words, if we don't get selling immediately on the open, you do not want to be short. This is a gap and go day. You do not want to be short. We would want to see it come in and aggressively sell and be responsive on the open to consider the short. We do not want to fade a gap. In general, we don't want to fade a gap. The gap was created by a higher time frame. We call that the OTF, or the other time frame. And they didn't bother to wait or recheck these regions, these areas, and we had pretty good migration of value in the overnight session. We had value moving up to around the 25 area, or whatever it is, wherever it is now. I think it's 21 or so. We had pretty good migration, pretty good checking, back checking, and it's holding up here. So we don't want to jump in here and say, this market's too expensive, let me go sell it. The market has to show you that. Okay, so that's key. Same thing goes for the NQ. The NQ, however, has really good structure to trade against. The NQ is right in the singles here. If the NQ starts to sell off, you're looking to fill the singles all the way back into this 787 area or so before we have to wait and see what it does next. So the NQ has 787, and if it decides to push lower, then it's free and clear. In my opinion, it's free and clear to 745, and then the prior high at 736. Otherwise, the NQ is looking to take back this sell-off day, this Thursday from a couple weeks ago or last week, and 16,000 becomes not 16,000, 15,900 becomes the next key target above. So watch carefully this morning. Watch carefully this morning, and watch for what is the quality of the sellers when they come in, what is the quality of the buyers when they come in. The flow is for the buyers currently. The sellers will have to really show us their hand, that they have some strength for us to jump in. even if you miss the first move down, it's okay. It is already showing you that it's exhausted. And so we just look for the second move or the third move or whatever. Our goal is not to catch the top and the bottom. Our goal is to catch what's in between. I want to remind you, I want to leave here and remind you that the sale that's going on with Convergent Trading is coming to an end on Monday. Those of you who are looking to explore Convergent Trading and who are looking to do the Trade Right program and kind of set themselves up with an accountability partner, get the news feed, get the market stats reports, all that good stuff, this is your chance. This sale, once it's over, it is over. It ends on July 31st. It's 20% off on a quarterly membership for new and returning traders. Check it out. It's a good chance to check it out. If it's not for you, that's fine, but it's an opportunity for you to get in and take a look. Good luck.
NASDAQ.